Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to Indian Accounting Standard 21, that is effect of change in foreign exchange rate part 2. That is the continuation of part 1 which I had discussed earlier. Today we will complete our topic. Some of the left topics are, that is the importance of functional currency transactions, then foreign operation definition, difference between local presentation currency, local currency and functional currency, then initial recognition of foreign operations, initial recognition of foreign currency transactions, then concept of foreign operation, translation principles of foreign operations, and some examples, some important examples, and also some of the concept related to functional currency and foreign currency transactions. So let's start our topic. Now, what are the importance of functional currency? Why the company will determine the functional currency? In order to measure its asset, liability, equity, income, expense. In order to measure all these, the company will determine the functional currency. In its functional currency, it means all the journal entries are passed in functional currency, operations are based in functional currency, and therefore all the operations are based on functional currency, and therefore journal entries are also passed in functional currency. An entity's functional currency reflects the underlying transaction. Whatever the entity's functional currency, which reflects the underlying transaction, event and condition that are relevant to it. That is sales, cost, any transaction the company made are in which currency. What are the events, what are the conditions to determine the functional currency? It is reflected through its underlying transactions. Normally functional currency will be constant. It will not change every year, but there may be a circumstances in which it may be changed if there is a change in underlying transaction, event and condition. Like if the functional currency is in INR, but for any transaction it is required by the law to change its functional currency. To change its functional currency, then the company will change its functional currency. Now, what is the difference between local currency, functional currency and presentation currency? Local currency is that currency in which the organization is based. Means where the country in company is situated, where the company is domiciled, registered. That currency is the local currency of the organization. Means the currency of a country in which the operation is based. For example, a company is situated in India and operates in India and registered in India will prepare its financial statement in INR. Suppose local currency, one example is that Reliance is based in India, it's operate from India and its functional currency is India and its local currency is also India and its presentation currency is also in Indian INR. Functional currency means the currency of the primary economic environment in which the entity operates. That is the currency of a country in which the entity operates. Its functional currency will be only one. There is no multiple functional currency. This is explained by example. Suppose Indian entity sold its product to foreign entity and receive its consideration in foreign currency. Suppose A Limited is an Indian company and sold its products to B Limited, which is a foreign company. And B Limited remit the consideration to A Limited in foreign currency. Suppose in USD. In the example, company operates its function from India, domiciled in India, invoices are made in INR. Sales are determined as per the thought process of Indian market. Costs are also paid in INR, but the receivables are in USD. So the USD is the foreign currency for Indian company. That currency is the foreign company. So the functional currency of Indian entity is an INR, and USD is the foreign currency. Foreign currency is that currency which is other than functional currency. Means foreign currency is always different from functional currency. Now, what is the presentation currency? The currency in which the financial statement are presented. It may opt for multiple presentation currency. They may present its financial statement in multiple currency. It is the voluntary choice of the entity in order to understand its financial statement to the investors. Suppose an entity having its subsidiary in USA, an Indian organization having its subsidiary in USA. The operation of the USA based company is to sell goods manufactured in India. Means the head office holding company is in India and its subsidiary is located in USA, and the USA based company is to sell goods manufactured in India. USA company would most likely maintain its account in, because they are based in USA, they maintain its account in the local currency. Whatever the currency they have in local market, they will maintain their accounts in USD, the local currency. While the functional currency would be INR, because the holding company is in INR, the company manufactures these goods in India, the operations are maintained in India, the thought process for determining the sales price is based on determined as per Indian factors, determining by seeing the Indian factors, the costs are paid in India. So the functional currency would be the INR, reflecting the major economic operations in India. However, for the presentation in consolidation, because in holding subsidiary relationship, the financial statements, the standalone financial statement are prepared for both the organization in local currency, but for consolidation purpose, the company will present their financial statement in the functional currency of the holding company. As the accounts are maintained by the US company is in USD, they may prepare their balance sheet in USD. Firstly, they prepare their balance sheet in USD, then they will translate for the presentation purpose in INR for consolidation purpose. What do you mean by foreign currency transaction? Foreign currency transaction means is denominated in foreign currency and settlement are also done in foreign currency. Means the currency which is other than functional currency. Foreign currency is other than the functional currency of the reporting entity. Means if the functional currency is INR and consideration received in USD, that USD is the foreign currency for an Indian entity. These transaction includes when an entity buy. If an entity buy anything from foreign market and invoices are raised in USD, then the company, Indian based company, has to pay for that in foreign currency. If the company sell goods, then it receive consideration in foreign currency. So buy or sell goods and services whose price is denominated in foreign currency. Or if the company borrow any loan from foreign market or lend any money to the foreign market, when the amount payable or receivable are denominated in foreign currency. Means borrow anything or lend anything to the foreign market, then payables or receivables are denominated in foreign currencies. Then that transactions are also known as foreign currency transaction. If any acquire any asset from market, any property, plant, equipment acquire from the foreign market, or sell any property, plant, equipment to foreign market, and settle any liability which is denominated in foreign currency, that transaction is also considered as a foreign currency transaction. So these transactions are considered as which is denominated in or required to make settlement in foreign currency, means the currency which is other than the functional currency of the reporting entity. Initial recognition of the foreign currency transaction. How we will recognize? Look the spot exchange, foreign exchange rate on the date of transaction, that is to be taken into consideration at initial recognition. Means a foreign currency transaction shall be recorded on initial recognition in functional currency. Date of transaction will be the date of transaction on which it's first qualify for recognition in accordance with Indian accounting standard. Average rate is to be used if the foreign transactions are high. Means if the transactions are high during the year, then they will select they will not take day-to-day rate, exchange rate. They will select whether the monthly average rate or half yearly average rate or quarterly average rate, whatever the average rate, they will select for calculating their settlements. And if the exchange rate fluctuates, if the exchange rate fluctuates significantly, then they use spot rate. If the transactions are high, then they will take the average rate. But if the exchange rate fluctuates very highly, then they will take the spot rate for calculation purpose. This is to be explained by example. Suppose A Limited has purchased a machinery from USA for $4 lakhs on 1st February 2022. The functional currency would be in INR. At that date, the exchange rate will be $1 equals to rupees 70. At initial recognition, the asset will be recognized at the exchange rate on the date of transaction. That is on 1st February 2022, they will recognize the property plant account debit, that is $4 lakhs into rupees 70 per dollar, that is 280 lakhs to the creditors for asset, because they had not paid for that. They will book to the creditors account. They make the payment to the foreign creditors on 23, that is 20 March 2022. On that date, the exchange rate will be rupees 65 per dollar. They will make the payment to the creditors on 20th March. So on the date of making payment, what they will do the entry in the books, the company settle its liability and make the payment to the creditor on 20th March 2022. On that date, the company will make reverse the entry, that is creditor for asset account debit to 80 lakhs, and they pay to the bank. They purchase the dollar in order to pay to the creditor at what rate? At the rate 65. So they pay to the bank at that rate, the dollar rate will be reduced from 70. So they has to pay 260 lakhs only. 260 lakhs. And the differential amount is to be the foreign exchange gain which is recorded in the PL account, that is 20 lakhs. So creditor for asset account debit 280 lakhs to foreign exchange gain which is credited to the PL account as income from foreign exchange 20 lakhs, and to bank account, that is the amount, the dollar which is purchased from bank in order to pay to settle the liability is, because at that date the exchange rate will be 65. So the amount will be reduced from 280 to 260 and the company will make a gain of 20 lakhs in the books. This is not the original gain. This is the gain as per. Now what was the effect of change in foreign exchange rate? Reporting at each balance sheet date the change in foreign currency transaction, means at each balance sheet date, the company will report the change in foreign exchange rate in its financial statement, even if there is no transaction during the year, but there is a change in the rate of foreign exchange rate, then also it will create an effect in the balance sheet of the reporting entity. There are two items, that is monetary items. Monetary items are that items which are translated by using closing rate. Monetary items are like debtors, creditors, loans, items which are settled. Monetary items which are to be received or paid are in a fixed or determinable number of units of currency. So it will be translated by using closing rate. Suppose the company has taken a loan and during the year the company does not make any transaction, and at the end of the year the company has to pay interest on that. So the company will make the effect of that is at the opening and the closing of the year. For example, the example of monetary items are debtors, creditors, employee benefit and pension to be paid in cash, provision settled in cash, lease liability, dividend paid in cash, loans, all these are the examples of monetary items. Non-monetary items means which are measured at cost and also measured at fair value in case of revaluation. Non-monetary items means it is not fixed, but monetary items are fixed. Non-monetary item means no fixed or determinable number of units of a currency. If it is measured at historical cost, then translate it by using the rate at the date of transaction. The date on which the transaction is made, on that spot rate it is measured. Or if it is measured at fair value, that is if revaluation is done on that asset, then translate it by using the date on which revaluation is done. The example of non-monetary items are goodwill, property, plant, equipment, ROU asset, inventories, land, intangibles. Monetary items are that items. If any gain arises due to monetary item, foreign exchange fluctuation, it will charge to P&L. But in case of non-monetary item, if any gain arises in case of historical cost, then it will be charged to P&L. But in case of fair value, it will not directly charge to P&L, it will go through OCI in case of revaluation. This is to be explained by example. Suppose a car is purchased on 1st April 2022 at $5 lakhs from Texas, and on that date the rate of exchange will be rupees 65 per dollar. On 30th September 2022, the car is revalued. Means the car is purchased on 1st April and on 30th September the car is revalued by $6 lakhs, and the car is purchased at $5 lakhs. And on that date the exchange rate will be 68 rupees per dollar. And 31st March 2023, the rate of the currency, the rate will be 70 per dollar, and on this date the company make payment to the overseas supplier. Useful life of the car is 10 years, functional currency is in INR, and tax rate will be 30%. So in this case we have multiple transactions. Firstly, we have to make the initial recognition of purchase of the asset. Then we will make the recognition of revaluation, because revaluation is made during the year. Then we will pass the closing entry, closing exchange fluctuation on the date. Then we will make the payment entry. The payment is also made in 31st March. We also charge depreciation on it, and we also create DTA on it, because the tax rate will be given at 30%. So it is an asset, it's a non-monetary item. So how we will do we will check. Firstly, we will pass the initial entry, that is on 1st April when the company purchases a car, then it will debit the car by $5 lakh by multiplying the exchange rate rupees 65 per dollar and then determine 325 lakh rupees, and they will credit the creditor account because the liability is not settled immediately. On 30th 9, that is on 30th September, evaluation is done of car and the value of the car is increased by $1 lakh. That is, the company purchased a car on $5 lakhs, but after revaluation it becomes $6 lakhs. So on the date of revaluation, the rate of exchange will be 68 per dollar. So the car account is again debited by the differential amount, that is recognized earlier. Means 5 lakhs we will recognize at the exchange rate of 65. Now valuation increased by 1 lakh because 6 lakhs minus 5 lakhs is become 1 lakh, and also the exchange rate we will recognize earlier. We will reduce that. That is by how much? Now the rate will be 68 and previously we will recorded at 65. So we will only recognize the differential amount minus 5 lakhs which is charged to revaluation reserve, because earlier we will recognize that at 65. So whatever we will recognize at 65, it is to be charged to that account. That is car account debit 83 lakhs, revaluation reserve OCI, that is 6 lakhs minus 5 lakhs into 65 per dollar, which is recognized earlier. And also there is a foreign exchange gain. This is to be given to the foreign exchange reserve, and there is a gain of foreign exchange, that is 68 minus 65. Whatever the differential amount of in 6 lakhs is to be charged to foreign exchange gain and loss. That is, there is a gain of 18 lakhs. On 31st March, the liability, the creditor is to be paid off. So the creditor account which is created earlier on 1st April 2022 by 325 is to be debited, because at we will already created that liability. Now in order to pay that liability, we have to go to the bank, because $5 lakh we have to pay to the creditors, and at that time the dollar rate will be 70. So we have to pay 350 lakhs for purchasing that $5 lakh in order to pay that creditor. Because the creditor liability which was created earlier is 325 lakhs, we incur a loss on foreign exchange by 25 lakhs, because the differential amount will be the foreign exchange loss. So creditor account debit 325 lakhs, loss on foreign exchange 25 lakhs, to bank account 350 lakhs on 31st March. Then what we will do? We will charge depreciation on asset because the useful life of the asset is 10 years, and we had also created a revaluation reserve on that. So depreciation which we will made, actual depreciation on car will be on the value of the asset. Total value of the asset is 325 plus 83, that is 408 lakhs, and we will make depreciation over the useful life of 10 years. So depreciation on asset will be 40.8. This depreciation is to be adjusted with depreciation charge to P&L 32.5, which is the depreciation, and remaining balance is to be adjusted with revaluation surplus OCI, which is created earlier at the time of revaluation. So we will adjust with that. Depreciation account debit 32.5 to revaluation surplus OCI 8.3 to accumulated depreciation on car, that is depreciation account debit 32.5, that is on original cost, and on revaluation surplus we will make whatever evaluation we made, that is 83 divided by 10, that is 8.3, and total depreciation will be, total accumulated depreciation on car will be 40.8. Now we will make deferred calculation on 31st March. That is, as per accounting based on the date of transaction, we will make the accounting asset as per books of account. The asset WDV of the asset will be 325. The carrying amount of the asset is 325 and tax base is 320. On the evaluation date, the tax accounting book carrying value of the asset is 408 and the tax base is 325 lakhs, because the revaluation effect is not given in Income Tax Act. As on 31st March 23, difference, that is the depreciation we will charge on that asset, that is 408 minus 40.8, and we will considering the useful life of tax base is also 10 years. So we will also charge depreciation as per Income Tax Act, that is 32.5, and the differential amount on which tax rate is applied, then we will, as the carrying amount of the asset, as the carrying amount of the asset is more than tax base, carrying amount of the asset, it is not an liability. As the carrying amount is more than the tax base, as per Ind AS 12, DTL will be created. DTL would be created because it's an asset. The opposite will be created. As on 31st March, we will determine, because all the transactions, the revaluation surplus are charged to OCI. So deferred tax calculation is also charged to OCI. So OCI account debit 22.41 lakhs, that is the differential amount into tax rate, negative tax rate, to DTL account, deferred tax liability 22. We will extend this example by inserting some more concepts, like if in the previous example, if the creditor are paid on 30th June 2023, if the creditor are not paid on 31st March and it was settled on 30th June, that is after the reporting date, and on that date the exchange rate will be 66, then how we will make an entry in the books? In our example, 31st March rate will be 70 per dollar, and on the date of recognition the rate will be 65 per dollar. On the closing rate, that is 31st March, we pass exchange gain and loss entry. Because the liability is not settled on 31st March, we will make an entry of creditors gain and loss, like if any fluctuation, because it was in foreign currency lying in the book, we will make the foreign currency transaction if there is loss or gain. So the date of recognition rate will be 65 and the closing rate will be 70. So how we will determine this? Because the creditor is 5 lakhs at the rate 65. Now the creditor will be charged with the differential amount, increased by the difference, because the exchange rate will also increase. So rupees 70 per dollar minus rupees 60 per dollar multiplied by the 5 lakhs dollar. So it will make 25 lakhs rupees, which is the foreign loss, foreign exchange gain and foreign exchange loss, forex loss charged to P&L, and forex loss account debit 25 lakhs to the creditor account by 25 lakhs. So creditor will be increased by 25 lakhs. Previously the creditor will be 325, now it increased to 350 lakhs. 350 lakhs, because it is increased by 25 lakhs. On the reporting date, the creditor will be 350 lakhs. Now on the settlement date, that is on 30th June 2023, the creditor will be paid off. Now the creditor is at 350 lakhs lying in the books, account debit, and what we will credit? The exchange rate at which the dollar is purchased is 66 at 5 lakh. Dollar is to be purchased at in order to settle the liability at the exchange rupees 66 per dollar. So 66 into 5, that is 320 lakhs, and remaining amount is the foreign gain, which is to P&L, that is 30 lakhs. So creditor account debit 350 lakhs, to bank account 320 lakhs, to foreign gain PL 30 lakhs. Now comes the concept of Ind AS 10, that is event occur after balance sheet date, along with the concept of Ind AS 21, that is effect of change in foreign exchange. In the above example, we will merge this above example with Ind AS 10, that is event occur after the balance sheet. Whether we will consider that exchange rate. Suppose in example, the date of initial recognition is 1st April 2022. Reporting date is 31st March 2023. Settlement date will be 30th June, on which the liability is paid off, and the board will make an approval of the financial statement on 30th September 2023. Now the question is, can we adjust this settlement in the financial statement as per Ind AS 10? Because the settlement is done after reporting date but before the approval of the financial statement. So can we take into consideration this adjustment in the reporting date? Answer is no. We will not make this adjustment in the financial statement, because these transactions are not existed on the reporting date. Though it is existed after the reporting date before the approval of the financial statement, but the event is not existed on the balance sheet date. It is a non-adjusting event which occur after the balance sheet date. If there is any evidences that the event is existed on the balance sheet date but it incur after the balance sheet date, then we will take into consideration. But at the reporting date, the exchange rate will be 70. So we will not take into consideration the date on which the settlement is made, that is after the reporting date. We cannot make the adjustment of these transactions as the event is not existed on the balance sheet date, though it occurred before the approval of the financial statement. It will be adjusted in the next financial year, in the next year in which actual settlement has to be done. So this is the concept of event occur after the balance sheet date but before the approval of the financial statement, merge with Ind AS 21. Now exchange difference arises due to following reasons. PPE, non-monetary item. This is non-monetary item which was initially recorded at spot rate, but at the closing date the exchange rate will be different. For that purpose also, because of monetary item also there is a difference arises because of the settlement of liabilities, debtors or creditors, all these, and the settlement of liabilities in the same period, if the period is same or subsequent period, then also difference will be arises. How we will recognize this difference in books? In case of monetary items, if the monetary items are is there like loans, debtors, creditors, all the fixed item, fixed denominated item, then they will directly recognize to the PN in the year in which they arise. In case of non-monetary items like goodwill, PPE, ROU asset, these intangible assets, all these items, in case of revaluation, it will be recognized in OCI, and if it is in case of historical cost model, they will recognize any gain and loss is to be recognized in P&L. So in case of revaluation, it will be recognized in OCI. In any other case, it will be recognized in P&L. Like if they follow cost model, they will recognize in P&L. Now there comes the concept of Ind AS 109, which is merged with the concept of Ind AS 21. In case of monetary item, that is monetary items, we are taking the example of loan. This example is related with loan, that is the monetary item. How we will treat this loan? By considering the facts of Ind AS 109 and also by following Ind AS 21. Suppose XYZ Limited has taken a loan on 1st April 2022 from a foreign financial institution of $100 lakhs. And in order to take that loan, they incur some processing cost, which is $10 lakhs, which is $10 lakh dollars. Interest paid annually will be $10 lakh dollars, which is incur on every 31st March, which is to be paid on every 31st March every year. Loan is taken on 2022, and after 3 years the loan is to be repaid, that is on 31st March 2025. Loan is repaid at a premium and the effective rate of interest will be 11%. Relevant exchange rate on 1st April 2022 will be rupees 44 per dollar, and on 31st March 2023, that is the closing rate, that is rupees 70 per dollar, and average rate will be on 31st March 2023, that is average rate during the year transaction will be rupees 67 per dollar, and the functional currency is in INR. How we will recognize this? Initial measurement amount of the loan, the finance cost during the year, the closing balance, exchange gain and loss, and its treatment in the books of XYZ Limited as per Ind AS 21 for the financial year 22-23. So how we will recognize this? How we will make the calculation? Firstly, we will initially recognize the loan at fair value because it's a monetary item, and in Ind AS 109 it is said that if loan is recognized, then its transaction cost, processing cost or incremental cost is to be reduced from the loan amount. So in this case the loan amount will be, amount is 100 lakh dollars, and the processing cost is $10 lakh dollars. So we will reduce that $10 lakh dollars from $100 lakh dollars to determine the actual amount of loan. So actual amount of loan is 90 lakhs dollar. Now we will convert that 90 lakhs into INR by taking into consideration the spot rate on which the transaction is done, and the rate of exchange on that date will be 49. So it will be, the loan amount will be rupees 4,410 lakhs. Now we will calculate interest at the rate, effective interest rate, that is 11% on 31st March 2023. On that date, we will take into consideration the average rate, that is for interest calculation we will take the average rate, that is 67. per dollar. So interest on 90 lakh dollars at the rate 11%, that will be 9.90 lakhs dollar, and we will convert this interest into INR by considering the average rate, that is rupees 67 per dollar, which comes to rupees 663.3 lakhs. Then the actual amount of interest is paid at that is $10 lakhs on 31st March 2023. At that date, the exchange rate will be 70 per dollar. So amount in INR will be 10 lakhs into 70 per dollar, that is 700 lakhs is to be paid. So amount paid actual में 700 lakhs, interest is 663.3 lakhs, and actual amount of loan is 4,410 lakhs. Now the closing, how we will find out the closing balance in dollar, that is opening balance, that is 90 loan amount plus interest, that is 9.90 minus paid, that is 10 lakhs. All in dollars to determine the closing balance, that is 89.9 lakhs dollar, and we will convert that closing balance in INR, that is by taking into consideration the closing rate as on 31st March 2023, that is rupees 70 per dollar. So it becomes the closing balance in INR, that is 6,293 lakhs rupees. Now what was these are the opening balance, closing balance, interest amount, all we will considered in INR and also in dollar. Now we will find out the foreign exchange gain or loss in INR. How we will find out? The opening balance in INR is 4,410 lakhs. Interest thereon is in INR is 663.3 lakhs. We will add this, we will deduct from that the closing balance and also the amount paid. The differential amount will be the forex exchange loss, because the closing balance and an amount paid is more than the opening balance and interest paid. So the difference is forex loss. Item loan is a monetary item, it is to be charged to P&L directly. In case of non-monetary item, we will see the fact whether revaluation is done. In case of revaluation, it is to be charged to OCI, and in case of historical model, it is charged to P&L. Concept of non-monetary item in case of inventory, that is Ind AS 2, and property, plant and equipment in case of impairment, if impairment by following Ind AS 36. So in case of inventory, what we will check? How we will determine the carrying amount, cost or NRV, whichever is lower. In case of impairment of asset by following Ind AS 36, how we will determine the carrying amount? We will determine the carrying amount before considering impairment and also the recoverable amount, and we will take into consideration the carrying amount or recoverable amount, the lower of the two. How we will determine the recoverable amount? Recoverable amount is determined by comparing lower of value in use, list of the two, value in use and fair value minus cost to sell. Firstly, we will determine the value in use, then we will find out the fair value minus cost to sell, and then we will compare both the values and we will take into consideration the lower of the two to find out the recoverable value. And if the recoverable value is less than carrying amount, then the impairment loss is there. And if the recoverable amount is more than carrying amount, then there is no impairment loss. So how we will check? In case of inventory and also in case of asset, we will first compute the cost of inventory. How we will compute? By taking into consideration cost or NRV, whichever is lower, and also in case of asset impairment testing, we will find out the carrying amount. Carrying amount, how we will find? By if we will purchase an inventory for foreign market, we will translate it the spot exchange rate on the date when the transaction is to be done. And also in case of asset PPE, we will purchase an asset. If any asset is purchased from foreign market, we will convert that asset into the spot exchange rate on the date on which the transaction is done at a historical cost. And then after that, step 2, what we will do, we will determine the NRV. In case of inventory, we will find out the NRV, and cost or NRV, whichever is lower, in order to determining the carrying amount of the functional currency in case of inventories. If the carrying amount is less than the recoverable amount, then is less than the recoverable amount, then there is no impairment. If recoverable amount is less than carrying amount, then there is an impairment test. There is no impairment. If the carrying amount is equals to recoverable amount, then there is no impairment. This is to be explained by example. This is the example. An entity purchase a PP, that is the non-monetary item of $1 lakh on 1st April 2022, and on that date the exchange rate will be rupees 67 per dollar. Due to some technological issue in the machinery, management want to do the impairment testing and estimated that the recoverable amount would be $84,000, and on that date the exchange rate will be rupees 80 per dollar. This is the first case. Then the second case, where the recoverable amount is 84,000 and the exchange rate will be rupees 60 per dollar. And in third case, the recoverable amount would be $1 lakh and the exchange rate on that date will be rupees 65 per dollar. Discuss the treatment of the above transaction by taking into consideration Ind AS 21 and Ind AS 36. So in first case, what we will check? Because the initial recognition, the company purchased the property, plant and equipment at $1 lakh on 1st April 2022, and on that date the exchange rate will be 67. The cost of PPE is 1 lakh into 67 per dollar, that is 67 lakhs. That is the carrying amount of PPE. And the step 2 is the recoverable amount. How we will, if the recoverable amount, the company has done an impairment testing and the asset is impaired, because in dollar terms the cost of PPE is 1 lakh, but it is reduced after impairment by 84,000. Though it is reduced in dollar terms, but the functional currency are in INR. So let firstly check in functional currency. The exchange rate on that date will be 80. So we will find out the recoverable amount by multiplying the exchange rate on the date when the transaction recoverable amount is to be done, that is rupees 80 per dollar. So it becomes 67 lakhs 20,000. So in functional currency, in INR terms, the recoverable amount is more than the carrying amount. Though there is an impairment loss in dollars, but in functional currency, that is an INR, there is no impairment loss according to the guidelines given by Ind AS 21. As the recoverable amount is more than carrying amount in INR terms, and then the company will not recognize impairment loss in its books. So there is no impairment as per Ind AS 21, because the recoverable amount is more than carrying amount, in terms of functional currency, not in terms of foreign currency. In next case, the recoverable amount will be $84,000 and the exchange rate on that date will be 60 rupees 60 per dollar. Let me check. Cost of PP in INR will be 67 lakhs. Recoverable amount, though there is a decrease in foreign currency, the impairment testing, but in let us check in functional currency, it also decrease, because from 67 lakhs it becomes 50 lakhs 40,000. So the recoverable amount is less than the carrying amount. So there is an impairment loss both in terms of dollar and also in functional currency, that is in INR. Then there is an impairment loss according to the Ind AS 21, as the recoverable amount is less than the carrying amount in INR terms, and the company will then recognize the impairment loss in its books, and all the impairment loss is to be charged to P&L. So impairment loss PL account debit, the differential amount, that is 67 lakhs minus 50 lakh 40,000, that is 16 lakh 60,000, is to be charged to P&L as impairment loss to PPE, property plant. In third case, what they will do, where the recoverable amount will be 1,10,000 and the exchange rate on that date will be 60. In this case, after impairment testing, the amount, recoverable amount in foreign currency would be increased from 1 lakh to 1,10,000. But the exchange, now we will check in functional currency. Now the cost of PP in INR will be 67 lakhs, that is the carrying amount in INR, and recoverable amount will be $1,10,000 into 60 per dollar, that is 66 lakhs. It will not increase. So there is an impairment. In this case, there is no impairment loss in dollar terms. Though there is no impairment loss in dollar terms, but there is an impairment loss in functional currency, that is in INR, according to the Indian Accounting Standard 21. As the recoverable amount in functional currency is less than the carrying amount, and then the company will recognize impairment loss in its books. So impairment loss is the difference, that is 67 lakhs minus 66 lakhs, that is 1 lakh to PPE account. Foreign operation means conducting any operation with subsidiary, associate, joint venture, branch. Means if any parent company has any subsidiary, any operation with subsidiary, associate, joint venture, branch, that means that is the foreign operation. This is to be explained by example. Suppose the parent company is in India and the subsidiary is situated in US and their operation is going on. That operation is to be said as the foreign operation. Means conducting any operation with subsidiary, associate, joint venture, branch, that operation is going to say as foreign operation. What are the factors to be taken into consideration for determining the foreign operations? Factors of foreign operations are nature of the activity. First, we will see the nature of the activity. Whether the activity with the foreign operations are extensive in nature or means in the form of extension, they are working as in the form of extension, or they are working as an autonomy, means they are operating as their own, or they are working according to the direction of the parent company. So the nature of the activity first need to recognize what kind of subsidiary is this, whether they are independent or whether they are dependent on the parent. So two types of nature of the activities: entity which operates as an extension, Like this is to be explained by example. Suppose any subsidiary is the extension of the parent company, which means that they are just an extension. They work according to the direction of the parent company. They did not take any of their own decision. Whatever the parent company say, they work accordingly. They sell the goods given by the parent company and remit the cash to the parent company. That work is to be done by the extension subsidiary. This is to be explained by example. Suppose an entity is located in India and his parent company is located outside India. Means parent is outside India and the subsidiary is located in India. These Indian company work according to the direction given by the parent company. Means the US company, whatever the US company say, the Indian company do accordingly. The Indian company does not have the power to make decision. It is influenced by the parent company. All the sales, all the cost regulations are monitored by the parent company. Indian company does not have any power to monitor that. So it's just an extension of the parent company. It does not take any decision of its own. It works according to the direction of the parent company. Then the parent functional currency, whatever the parent functional currency would be the subsidiaries functional currency. But some of the entities they are the independent entity. They operate as an autonomy. They have the power to make decision. They does not work according to the parent company. Parent company's work is only at the initial stage to fund that company. After that the subsidiary works according to his own decision, collect its own money, sell goods according to its customer, expense his cost, operate his cost. All the cash flows is his cash flows. Loan is taken by him only and paid by him only. So all the decision is taken by subsidiary. It's an independent subsidiary. The parent duty is only to give fund at the initial stage. So suppose an entity located in India and his parent is located outside India. Parent is located outside India and subsidiary is located in India. This Indian company does not work according to the direction of the parent company and has the power to make decision. Those who are the autonomy entity, they takes decision of their own. They does not work according to the direction of the parent company. They accumulate cash of their own. They accumulate monetary items like their debtors are there, their creditors are there. They take loan from themselves, they pay loan from themselves, they incur expense of their own, they generate income of their own, they arrange borrowings, all substantially in local currency. All the transactions they do in their own currency. Therefore, it's functional. That company's functional currency would be their currency only, in which the entity operates and not that of the parent. So, I will explain why some practical example, that is the Nestle India Limited. Nestle India Limited is an Indian subsidiary which is the subsidiary of Nestle, which is the Swiss multinational company. Nestle is the Swiss multinational company and its subsidiary is Nestle India Limited. Nestle India Limited does not work according to the direction of the Nestle. Nestle India Limited takes his own decision, works, accumulates its own cash, his customers is their own. His if they take loan from their own local currency, they incur their own expense, they generate their own income, and their borrowings are their own. They will not take any borrowings or any loan from the Nestle. They only pay dividend to them whatever Nestle is invested in Nestle India Limited. So Nestle India Limited is an independent company. The company products are foods, beverage, chocolates, confectionaries. They were deal in food, beverage, chocolates and confectionaries. And these Nestle India Limited does not influence by the his parent company, does not influence by Nestle Swiss multinational company. It is influenced by its local currency, influenced by local economic environment in which it operates, and therefore its functional currency would be the rupee and not of the that of the his parent company. Then next factor is, for factor of foreign operation, is the percentage of transaction. Means if any company, if any subsidiary is making how much transaction, what percentage of transaction they are doing with their parent company. If the percentage of transaction is high, means they are doing day-to-day transaction, they are doing very on regular basis, the transaction are very high, then it is assumed that they are dependent on the parent company. And if the transaction with the parent company is low, then it is assumed that they are independent company. This is to be explained whether transaction with the reporting entity are high or low proportion of the foreign operation activity. It is to be checked by, we are taking the example of Nestle India Limited only. In the above example, Nestle India Limited operation with Nestle is high. Suppose we are assuming that if the Nestle India Limited operation with Nestle, means transaction with Nestle is high, their proportion of transaction is very high with Nestle, then if it is high, then it is the indicator, it indicates that probably majority of the transaction is with the parent. If the transaction are high with the parent company, it indicates that the subsidiary is a dependent company, and it works according to the direction of the parent company. And if the operation is low, in actual situation, whatever the actual situation, the practical situation, Nestle India does not depend on the Nestle. It's an independent company. That is the actual scenario. They only pay dividend to the parent company. The company is not actually remitting his retained earning to the parent company. It's only remitting, only paying dividend to the parent company. And it means, it indicates that the company is taking his own decision and it is an independent company. It is not influenced by the parent company. And the third factor of foreign operation is nature of cash flow. Whether cash flow from the activities of foreign operations directly affect the cash flows of the reporting entity and are readily available for remittance to it. Means we are taking the above example, the same example, means if the Nestle India Limited, that is the subsidiary company, on regular basis remitting his cash to Nestle on regular basis, then it is affecting the cash flow of Nestle. Means cash flow of Nestle is regularly affected by cash flow of Nestle India Limited. Means on regular basis cash is remitted to the parent company and it is a dependent company. Means they are remitting on regular basis, the subsidiary company is remitting cash on regular basis to the parent company and it is affecting the cash flows of the parent company. Then it is assumed that the subsidiary is dependent on the parent company. But if it does not remit any cash to its parent company and operates its fund of its own, Whatever they realize, keep their realization on its own itself and fund their operation by itself only. Therefore, then it is assumed that Nestle's, we are taking Nestle India example, then it is assumed that the Nestle's cash flow means parent cash flows is not affected by the subsidiaries cash flow. That is Nestle India cash flow. Fourth indicator, funding. Whether cash flows from the activities of foreign operation are sufficient to service existing and normally expected debt obligation without fund being made available to the reporting entity. In our above example, Nestle India Limited can take its own loan, finance itself, repay the loan from its own income and does not tell the parent company to repay its loan. In that case, Nestle India Limited is an independent company. It means they take their own loan, they fund itself, they repay their loan from their own income and does not tell to repay their loan to the parent company. So they are an independent company. This is the 4 factors to check the foreign operations. Factors of foreign operations are: firstly, the nature of the activity, then transaction, percentage of transaction are high or low, nature of cash flows and the funding. Then comes the translation principles of foreign operations. Consolidation purpose, how we will translate our assets and liabilities, at which rate we will translate our assets and liabilities into a functional currency. So income and expenses are to be translated at either at spot rate or at an average rate. Balance sheet item, assets and liabilities. All monetary items are translated at closing rate. Non-monetary item, whether at cost or fair value, all are translated at a closing rate, because these are the translation principles. We are not taking into consideration any foreign currency transaction. This is the operation which is already there in dollars. The balance sheets are prepared in dollars. We are just translating that assets and liabilities, income and expenses, in order to consolidate that items in our balance sheet. The foreign currency operation is there, and if the subsidiary balance sheet is prepared in dollar and the holding balance sheet is prepared in rupees, then the foreign subsidiaries dollar is to be translated into, all the asset, liability, income, expense is to be translated in Indian rupees. So what rate we will take into consideration for translation, that we will discuss. So income and expense of foreign subsidiaries is to be translated at spot rate or average rate. Balance sheet item, that is asset and liabilities, all are translated at closing rate. Equity balance sheet. Equity balance, if there is equity share capital, rate on the date of acquisition of subsidiary. If equity share capital is to be translated when the company will acquire, on that date of acquisition is to be taken into consideration for transferring the equity share capital, for translation of equity share capital. And the reserve, if pre-acquisition reserve, then the rate on the date of acquisition, and post-acquisition reserve, average rate during the post-acquisition period. In case of reserve, if FCTR is there, FCTR means all is to be recognized in OCI, that is the foreign gain or loss on translation. Whatever the assets and liabilities we are translating, there is some exchange difference, that we will called as an FCTR. FCTR OCI, and is to be recognized in OCI. That gain and loss is to be recognized in OCI, and that is to be due to difference in foreign exchange translation of all the assets and liabilities, the difference which is arises. If there is in case of a debtor, if the debtor is in holding company and that debtor is treated as creditor in subsidiary company, then at the time of CFS conversion, we are at the time of consolidation purpose, at the time of consolidation, we will remove the debtor and creditor, means that creditor and debtor all are eliminate from each other, that is the debtor and creditor. Debtor in holding company's balance sheet and creditor in subsidiary is eliminate with each other, because the creditor is in dollars, it is to be recognized at closing rate, and debtor is also recognized, all both are eliminated with each other, and if there is any difference, that difference is to be recognized as foreign currency gain and loss, and foreign currency gain and loss cancelled out with each other, and difference which will be arises, that is to be charged to P&L as foreign currency gain or loss, or if it is to be recognized as FCTR. In case of loan also, if the parent company has given loan to the subsidiary, they will convert, it is a monetary item, convert at a closing rate, and if the difference is there, that is to be recognized to P&L. But if the parent company given loan to the subsidiary for infinite period and did not call for any, the subsidiary is not paying any interest to the parent company for that loan, and they are not asking for repayment of loan, then it is assumed that that loan is given in the form of investment, and that is the investment, and that investment if transferred, then the difference if converted, it is translated at a foreign exchange, then it is the difference which is arises is to be goes to the FCTR and not to the P&L. Can functional currency change? Yes, functional currency can change. Functional currency also change if it is required by any law. Then prospective effect required to be given, means 3 balance sheet is required to be prepared and prospective effect is required to be given. And can presentation currency change? Yes, presentation currency can change. The entity can prepare multiple balance sheets according multiple presentation currency balance sheets required by any company, by investors. Yes, it can be changed, but the effect is to be retrospective effect required to be given, not prospective effect. Now I will explain the foreign operation by example. Means XYZ Limited acquire 80% of ABC Limited for rupees 10,40,000 on 1st January 2021, when the retained reserve of ABC Limited were $50 lakhs. Means ABC Limited is a foreign company and XYZ Indian company. Indian company acquired 80% of the stake of ABC Limited at rupees 10,40,000, and on 1st January 2021, and on that date the ABC has having a reserve of $50 lakhs. The financial statement of XYZ Limited and ABC Limited for the year ended 31st December 2022 are as follows. This is the financial statement of XYZ Limited, which is in rupees, which is an Indian company, and ABC Limited, whose financial statement is in dollars. Non-current asset, that is property, plant and equipment, 25,70,000, and in ABC Limited 88 lakhs, all are in dollars. Investment in ABC Limited in dollar is 10,40,000. Current asset 8,20,000, in here is 40 lakhs, and equity share capital in XYZ Limited 10 lakhs and ABC Limited 20 lakhs. Retained earning is 22 lakhs 30,000, and in ABC Limited it will be 86 lakhs. Then non-current liability, loan is 4 lakhs and ABC Limited 6 lakhs. Current liability 8 lakhs and ABC Limited 16 lakhs. This is the financial statement, financial position of XYZ Limited and ABC Limited. Then this is the profit and loss and comprehensive income for the year ended 31st 12/2022. That is revenue XYZ Limited in rupees and ABC Limited in dollars. Revenue 22,50,000 and the total comprehensive income will be 7,90,000. Dividend paid, gross profits, expense, all these are. And ABC Limited in dollars is 27 lakhs is the total comprehensive income. Then in the year ended 31st 12/2021, ABC Limited total comprehensive income was $24 lakhs. And on 31st 12/2021, ABC Limited paid dividend of $6,90,000. An impairment test conducted on 31st 12/2022 revealed impairment loss of $2,96,000 relating to ABC Limited goodwill. No impairment loss has previously been recognized. It is a group policy to translate impairment loss at a closing rate. All the loss is to be translated at a closing rate. It's a policy of the company. At the date of acquisition, XYZ Limited choose to measure the non-controlling interest in ABC at the proportionate share of fair value of net assets. So let's start. This is the retained earning or statement of change in equities for the year ended 31st 12/2022. That is the opening balance of retained earning of XYZ Limited and ABC Limited, dividend paid during the year, then total comprehensive income during the year 21/22, then balance as on 31st March 31st December 2022. This is the balance of retained earning. Then exchange rate on 1st January, opening exchange rate, rate on the date of acquisition, that is 1st January 2021, 9.4, and closing rate will be on both the years. 2 years consolidation is required. So 31st 12/2021 and 31st 12/2022 rate is given. Then average rate of both the years is to be given. Prepare consolidated balance sheet and statement of P&L and OCI as on 31st 12/2022. So let's start our illustration. Firstly, first step is to prepare a standalone balance sheet. All the first step is to restate the balance sheet of ABC Limited, which is in dollars, and we will convert that balance sheet into rupees term as on 31st 12/2022. Because we are required to prepare the balance sheet, consolidated balance sheet of 31st 12/2022, so we will convert the ABC balance sheet into rupees and restate that balance sheet which is in dollar into rupees. Convert that dollar into rupees. So asset is property, plant and equipment. The balance sheet is here. Property, plant balances is 88 lakhs. We are taking 88 lakhs PPE. We will taking the closing rate of all the assets and liabilities except equity and retained earning. So all the asset means property, plant and equipment is a non-monetary asset. We will taking the closing rate. What was the closing rate? That is 8.1 as on 31st 12/2022. So we will convert 88 lakhs divided by 8.1 because this is all in dollars and rate is also in dollars. So we will not multiply, we will divide determined in rupees. So PP is 10,86,420. And then current asset is also, that is, we will see the balance sheet. Current asset is 40 lakhs in dollars. We will convert by taking the closing rate. Closing rate is 8.1. We will convert in Indian rupees. That is 40 lakhs divided by 8.1, 493,827. This is the property, plant and equipment conversion. Then we will convert the share capital, retained earning, loans and current liabilities. Share capital is 20 lakhs. Share capital we will convert at, not at a closing rate. We will convert on the date on the date of acquisition. So on which date we will acquire our date on 1st January 2021. So we will take the rate of 1st January 2021, that is 9.4. So we will convert the share capital at 9.4. 20 lakhs divided by 9.4, that is in rupees 2,12,766. Then retained earning. Pre-acquisition retained earning. Pre-acquisition, it is already said in the question that the pre-acquisition reserve on the date of acquisition is 50 lakhs. That we easily recognize that it's a reserve that is on the date of acquisition of stakes. So on 1st January 2021, the reserve is 50 lakhs. That is the pre-acquisition reserve. So 50 lakhs is the translated on the date of acquisition, that is 9.4. We will divide 50 lakhs by 9.4 to get 5,31,915. Then we will calculate the post-acquisition profits. This is we will calculate by working note. So go to the working note, reserve. This is the pre-acquisition conversion on the date of acquisition 9.4 and the post-acquisition. Retained earning as on 31st December 2022 is, as we see in the balance sheet, it's a balance sheet of as on 31st 12/2022, and on that date the retained earning of ABC Limited is 86 lakhs. It is said in the question only. These 86 lakhs is included the post and pre-acquisition retained earning both. So we will bifurcate it. Pre-acquisition, we know that 50 lakhs is in on 1st January 2021, 50 lakhs. We will take into consideration, and remaining 36 lakhs we will divide that. We will break it. That is on 31st 12/2021. It is said in the question that on the year ended 31st 12/2021, the ABC comprehensive income is $24 lakhs. So on that date he has a retained earning of 24 lakhs. You will convert that average rate by taking the average rate. So average rate is, on the average rate of 2021 is 9.1. We will convert that on by taking that rate. So 9.1, convert 24 lakhs into divided by 9.1 to get 2,63,736 rupees. Then from that profits, dividend is paid. Here is also said in the question that dividend paid during the year 2021, ABC Limited total comprehensive income was $24 lakhs, and on that date ABC Limited paid dividend of $6,90,000. So 6,90,000 is paid, is removed from that income. So convert that dividend into, by taking the closing rate on 2021 will be 2021 8.8. So we will take that rate. We will take that rate and convert that to get 78,409. Then on 31st 12/2022, the balance is 27 lakhs dollar. That is said in the question, that is, we will take the revenue statement, that is the balance as on 31st 12/2022. The total comprehensive income is 27 lakhs and dividend paid as on 31st 12/2022 8 lakh 10,000. So we will convert that by taking the average rate and by taking the closing rate. We will convert that. That is the closing rate on 31st 12/20 8.1 and average rate is 8.4. That is this income, comprehensive income 27 lakhs is to be converted at average rate and dividend paid is to be converted at closing rate. So this is to be converted. Then we will get the post acquisition details here, like in balance sheet. The post acquisition 31st, that is 24 lakhs, is to be converted at 9.1 to get 2,63,736. Dividend is to be reduced, that is 78,409. Then next year's 22's profit is 27 lakhs, which is to be converted average rate. Then we will get 3,21,429 and dividend on that year it will be 8,10,000, which is to be converted at closing rate to get 1 lakh, which is to be reduced from the profit, and loan is to be converted at closing rate and current liabilities is to be converted. The difference between the assets and liabilities is to be taken as FCTR, is to be considered as FCTR, that is 1,57,205. The difference in assets and liabilities is to be recognized as FCTR, foreign currency translation reserve. This is the step 1 where we will restate our ABC balance sheet and convert the dollars into rupees. Now we will consolidate this balance sheet into the Indian balance sheet, means ABC balance sheet with XYZ balance sheet. So we will consolidate our balance sheet. Then firstly we will make a statement, that is PPE goodwill. Whether goodwill is to be recognized or capital reserve, we will check via note. So firstly we will make a note of that. First note is all the assets and liabilities is to be adjusted, means added. All the property, plant, equipment, current asset, borrowings, current liabilities, all is to be added of XYZ Limited and ABC Limited. So XYZ Limited का property plan है 25,70,000. So it will be 25,70,000, and whatever we have restated, that is PP is 10,86,420. 10,86,420. Then current asset will, as in this way we will add all the items, property, plant, current asset, borrowings, and we will keep this in the consolidated balance sheet. Property, plant and PPE we will take that is 56,420. Current asset we will take as 13,13,827. Then borrowing, that is loan, we will take 4,27,74,046. Then current liability is 9,97,530. Then other than this, we will check our working, that is equity share capital. Equity share capital, we will take the holding company's equity share capital, that is 10 lakhs. We will take that only, equity share capital of holding company 10 lakhs. Then other equity is to be, we will calculate the other equity. Other equity is the consolidated retained earning. Consolidated retained earning means the retained earning of standalone XYZ Limited is, we will check the XYZ Limited का retained earning, that is retained earning 22,30,000, that is 22,30,000. 22,30,000. Share of profit of ABC Limited means whatever the retained earning of ABC Limited. So ABC Limited का retained earning, ABC Limited retained earning, that is the retained earning, that is the retained earning of ABC Limited is pre-acquisition retained earning is 5,31,915, and we will take the 80% of 5,31,915, that is 3,25,405. Then FCTR we will take that FCTR, that is we will take into translation of dollars into Indian rupees, that is the FCTR, which is 1,57,205. We will divide that into the interest of holding and minority, means non-controlling interest, that is 80% and 20%. We will divide that. So 1,57,205 into 80%, which gives 1,25,760. Then we will calculate the impairment of goodwill and share of FCTR on goodwill. How we will calculate? We will calculate the cost of control, that is 80%, that is the calculation of goodwill or capital reserve as on on the date of acquisition. Investment in ABC Limited, we will make an investment in Indian rupees, that is 10,40,000, which we will translate at the date of acquisition 9.4, which gives rise to in dollars 97,76,000. We will reduce from that investment the share of equity share capital percentage which is taken by the holding company, that is invested by the holding. So from 20 lakhs का 80% it will be give rise to 16 lakhs, and pre-acquisition profit 50 lakhs into 80%, that give rise to 40 lakhs. So this is to be translated on the date of acquisition to give rise the that is 16 lakhs divided by 9.4, which give rise 1,70,203, that is equity share capital, and pre-acquisition profits 40 lakhs divided by 9.4, which gives rise to 4,25,532, and the 10 from 10 lakhs 40,000 we will reduce the equity share capital and pre-acquisition profit, which give rise a goodwill, because we had invested more, we paid more purchase consideration, so there is a goodwill, we pay for the goodwill, so that goodwill amount will be, the difference will be the goodwill amount, and that goodwill amount will be the 4,74,545. But due to foreign, if there is a difference, the difference is more, but there is a foreign goodwill is a monetary asset, so we will calculate at a closing rate. The difference is 41,76,000 as per dollars, and that we will convert into closing rate by taking closing rate. So that give rise to FCTR. The difference give rise to FCTR. That is 30,290. The difference give rise to FCTR, and that is the FCTR on goodwill. This balance is as on 31st/12/2021. The goodwill which we will recognize is on first at the date of acquisition. The balance is carried on the next year, and on first but FCTR we will calculate at the end of the year. So the FCTR will be 30,290. Then because we will recalculate the goodwill at the end of the year by taking the year-end rate, so which give rise to the foreign exchange fluctuation, and that difference is recognized in the FCTR. And the opening balance of the goodwill in 1st January 2022 will 41,76,000, and the closing on that year on 31st December 2022 impairment loss is there of $2,96,000. That impairment loss is to also be taken into consideration, but goodwill before impairment will be 41,76,000 at the rate 8.8, but after impairment we will reduce 4176 by 2,96,000, which give rise to 3880. That is to be translated at a closing rate, that is 8.1. So which will rise as on 31st/12/2022. The goodwill will be 4,79,001, and impairment loss is 2,96,000. That is also it also said in the question that it will be calculated at a closing rate. So we will take in the closing rate, that is 36,543, and the difference is that of foreign exchange fluctuation due to foreign exchange, and that is to be recognized in FCTR. So so this is the FCTR due to goodwill, that is 3290 and 41,010. So we will take that also, that is 71,300, and the impairment loss is that is 36,543. Impairment loss is this. So share of profits of ABC Limited, all these we will calculate. So retained earning will be 25,18,862. That is consolidated retained earning is 25,18,862, and consolidated FCTR will be 197,064. This is the other equity which will take into balance sheet as other equity, 27,15,926. And now non-controlling interest, and we also take the goodwill, that is goodwill calculation. Goodwill is 4,79,012, that is here 4,79,012. This we will take into retained earning. This FCTR we will take into retained earning. Now non-controlling calculation of post profits, we will also take in the post profits, that is 325,402, that is 325,402, and also the FCTR 125,764, 125,764. Now the calculation of minority interest, that is non-controlling interest, that is proportionate share capital, that is 20 lakhs ka 20%, 4 lakhs, convert at the acquisition date 9.4, which give rise to 42,553, and proportionate share of pre-acquisition reserve, that is pre-acquisition reserve is 50 lakhs ka 20%, that is 10 lakhs in dollars, and we will convert that at the date of acquisition rate to give rise to 1,06,383. Total will be the pre-acquisition profit 148,963 of minority, and then post acquisition profits we will accordingly we will calculate, as we will calculate of that of the holding. We will, in holding we take the 80%, and in minority we will take the 20% of that. That is post retained earning 24 lakhs ka 20%, dividend paid that is 6,90,000 ka 20%, then post retained earning 27 lakhs ka 20%, then dividend 8,10,000 ka 20%. Then we will calculate that on the date, closing date and average rate. Then it give rise to post acquisition profits will be 81,351, and FCTR will be 157,205 ka 20%, which give rise to 31,441, and total we will get the non-controlling part will be 2,61,728. We will give into the balance sheet. That is non-controlling interest 2,61,728. All the non-current and current liability we will calculate, which give rise to total of 54,49,259. This is the consolidation in foreign currency operations. So if you understand, if you like, please subscribe my channel, please share my channel. Thanking you for watching my video. Please share, like and subscribe my channel.